For more on this, we're joined by Dilin Wu. She's a business strategist at Pepperstone. Welcome back to the programme, Dilin. Now, we're seeing Brent crude hitting $85, which is the highest level in over 4 weeks now. How much of this is genuine panic over supply, and how much of it is just markets reacting to Donald Trump's rhetoric on a 20% cargo fee?
Well, I feel like it's kind of a both, but I wouldn't separate them too cleanly. I mean, the 20% cargo fee makes for a great headline, but honestly, the details are so vague that it's very hard to take it seriously as a actual policy at the moment, because nobody knows who collects the fees, how it gets enforced, and what kind of things would happen if you don't pay. So what markets are really reacting to is obviously the signal itself that the US is now willing to use Hormuz as an economic weapon, not only a military one. So that shift in framing matters, even if the fee itself never materializes. So down the road, I actually wouldn't be overly pessimistic about it. And I think we still need to take it more of a short-term noise than a long-term decisive factor to boost or to drive the oil market.
Now, on top of that fee, Trump is, talking about a naval blockade on Iranian shipping. If that remains in place, is $85 a barrel actually a low number for us?
Yes, I think that could be the case, actually, and maybe cheaper than most people realize. Because when the conflict first broke out earlier this year, Brent breached $120 per barrel. I remember the highest price was $128 per barrel. And that was when global inventories were still quite healthy and quite resilient. And 5 months in, those buffers have been drawn down significantly. Basically, China has started importing crude again in volume. So I think $84 to $85 per barrel pricing in a blockade that holds, but doesn't spiral. So if Iran starts, targeting non-Iranian vessels, or the 20% fees actually get enforced, that number moves quite fast. So yes, I would say 85 or 84 feels more like a temporary equilibrium than a ceiling.
Meanwhile, Asian markets seem remarkably resilient to those geopolitical risks. What's helping offset those concerns?
Well, I think the basic framework that Asian markets built this year, so basically this is a bilateral conflict, is contained, look through it, has basically held. And the AI hardware thesis gave investors a real reason to kind of ignore the noise. So that combination worked until maybe earlier today. And here's the thing. So most Asian economies like Japan, South Korea, Taiwan, and India are heavily rely on energy imports, and Asian countries collectively receive nearly 90% of everything that transits the strait. So it hits Asia, obviously, and in the cost of every barrel this economies runs on. So I think if this geopolitical tension further escalates, then it will add a lot of burden to the AI economies. But now we're still hearing a lot of noises. So the AI economies, or the Asian equities, can find some resilience at the moment.
Dilin Wu, great to have your analysis. Thank you.
Thank you.